Bitcoin's about $400 billion of this $900 trillion worth of global wealth. You see gold is 12 trillion and equities are 115 trillion. It used to be gold was equal to equity. If you go back 50 years, it used to be gold was about equal to equity. So what happened? Well, there's a lot of technology in equity.
Hey guys, welcome back to Everyday Finance. In this video, Michael Saylor discusses crypto and Bitcoin. According to Michael Saylor, Bitcoin represents about $400 billion of the $900 trillion in global wealth. While gold is valued at $12 trillion, equities amount to $115 trillion. Gold used to be considered equivalent to equity in the past. 50 years ago, gold and equity used to be almost equivalent in value. So, what caused the change? There is a significant amount of technology involved in equity. Gold is often referred to as a shiny, lifeless rock, but it holds great value, reflecting on the impact of technology on gold mining over the past 50 years. Years of experience in semiconductors show that mining gold is not made easier by mobile phones, right? What's the latest in the equity market? Well, you have Tesla and Apple. You have Google and Amazon at your disposal. If you have access to the internet and a telephone, you're all set. Technology has shifted the balance of power from gold to equity. Government plans examining the power dynamics in the bond market bonds are significantly influenced by government policy. Real estate is greatly influenced by government policy, and lots of things Michael Saylor discussed. So please watch the video to end, and share this video, and subscribe our channel Everyday Finance. Thanks.
I was thinking about Bitcoin and how Bitcoin plays into all this. And you can see in my chart, Bitcoin's about $400 billion of this $900 trillion worth of global wealth. You see gold is 12 trillion and equities are 115 trillion. It used to be gold was equal to equity. If you go back 50 years, it used to be gold was about equal to equity. So what happened? Well, there's a lot of technology in equity. You know, we talk about gold being a shiny, dead rock, but think about gold mining and think about what technology has done to gold mining in 50 years. Semiconductors don't make it easier to mine gold. Mobile phones don't make it easier to mine gold. Right? What's happened in equity? Well, you've got Tesla, you've got Apple, you've got Google, you've got Amazon, you've got the internet, you've got the telephone. So technology has shifted the balance of power from gold to equity. Government policy shifting the balance of power. Look at bonds. Bonds are driven very heavily by government policy. Real estate driven very heavily by government policy because government policy controls capital and cost of debt, and that drives real estate. And of course, there's money over here. So, most important point is the government is changing this field. Technology is changing this field, and you can work as hard as you want, but you're going to have to take into account government policy and technology if you want to actually survive in this world. The world reserve currency is the dollar. It's collapsing against assets like the S&P index, like real estate, like gold, like art. And this is a sobering thought. If we had sound money, the dollar wouldn't collapse. But you've probably seen this chart. This is the dollar collapsing against consumer goods. Consumer goods, you know, the dollar is 95% weaker. It means consumer goods are 20 times more expensive today than 100 years ago. Now, consumer goods are manufactured items, candy bars, bottles of water, Netflix videos. They're things that are coming off an assembly line and they're getting stamped out with a low variable cost. This is the cheapest, least scarce stuff in this civilization, and yet it's 20 times more expensive. Now, a lot of times government officials show you this chart and they say, well, this is the impact of inflation. This, in fact, was generated by the Bureau of Labor Statistics. But the sad fact of the matter is, this is as good as it's ever going to get for you. This is a different picture. What if it wasn't easy to stamp out manufactured biscuits or Netflix videos? What if you had to do work to dig the gold out of the ground? Gold is a bit harder. And so the dollar has collapsed 99% against gold in that same 100 years, not 95%. By the way, gold is not scarce. We keep creating more gold. We get better at it, but at the end of the day, it's a bit more scarce than, Netflix videos, and it's a bit more scarce than drywall. Let's talk about something that's even more scarce. The 500 most valuable companies in the S&P. The US dollar has lost 99.8% of its value against the S&P index over that same 100 years.
According to Michael Saylor, it's declining in comparison to assets such as the S&P index and real estate. Gold is similar to art, and it's a sobering thought that if we had stable currency, the dollar is not expected to collapse, but you have likely come across this chart. This is why the dollar is losing value compared to consumer goods and the value of the dollar. If something is 95% weaker, it implies that consumer goods are now 20 times more expensive than they were 100 years ago. Many years have passed, and consumer goods consist of manufactured items like candy bars and bottles. Netflix videos are like products rolling off an assembly line. Production is streamlined, resulting in a low variable cost for these items, making them the most affordable and readily available option. Civilization has become significantly more expensive, often costing 20 times more than before. When government officials present you with a chart illustrating the impact of inflation, it was actually generated by the Bureau of Labor Statistics, unfortunately, indicates that this is the peak performance we can expect. This appears to be a different image. What if eliminating manufactured products wasn't a simple task? Imagine having to choose between enjoying biscuits or watching Netflix videos, but then having to put in the effort to mine the gold from the ground, which is definitely more challenging. Let's back to the Michael Saylor interview.
That is actually a closer measure to the inflation rate. This is the world's strongest currency. This is the currency backed by the country that won every war in the last 100 years. This is as good as it's going to get for you. This is as good as it gets. It will get worse. Now, how do you measure inflation? If I measure inflation against something I can manufacture for free, inflation doesn't look that high. If I measure inflation against a yardstick that is fixed, that's thermodynamically sound, then you see the true measure of inflation. S&P is one example of that. This is Miami Beach. Miami Beach runs 96 blocks. There's that much beach. 100 years ago, there was that much beach. No amount of semiconductor technology or factories make more beach. The dollar has fallen 99.8% against the beach in 100 years. That's how you start to see what's really going on with the world's strongest currency. Now I have some bad news for you. We're not in America. We're in another country. Foreign currencies are collapsing against the dollar. This is the Argentine peso against the dollar. In 20 years, the peso goes from 1 to 500. The peso's lost 99.8% of its value against the dollar at the same time that the dollar's lost 75% of its value against the S&P index. I'll let you do the math. If you run a company in Argentina and you're going to work hard, you're going to have to grow your revenues from 1 million pesos to 500 million pesos over 20 years to stand still. And that's why I say no amount of hard work is going to solve the problem of being on the wrong side of an economic war. There's only one strategy here. You have to get out of that peso. You have to exit. This is the lira. This is before this week. It lost 95% of its value. Now the number is about 97% of its value against the dollar. This is the rupee. It's lost 90% of its value against the dollar. So that 99.8% loss is another 90%. So we're kind of running out of numbers to calculate just how much of your wealth has gone from you to the government. When the government actually collapses the currency 99.9%, what it means is over 100 years, they in essence take all of your wealth and they redistribute it to their cronies, to whoever they want. And that's the rate at which it's going. This is Pakistan, 82% against the dollar. This is the Brazilian real, 65% against the dollar. Conclusion. If you want to preserve your wealth, you have to convert that currency into an asset that's scarce, desirable, portable, durable, and maintainable. Right? There are certain things that are scarce and desirable, but they don't move, like beachfront property. And by the way, maintainable, if you own $1 million of property in Miami, you have to pay $20,000 a year, every year, to maintain it, and it gets assessed up. So you have to have $1 million to cover the taxes on $1 million of property in Miami Beach over about 20 years. You can't maintain it. So you're going to be a smart investor. Here's smart investors, people bragging about making money in the stock market. The S&P index is going up 7 to 8% a year. And so you must be really smart. You invested in companies that are making good decisions. Look at the money supply. The money supply is going up at the same rate as the S&P index. And so what you begin to realize is most investment gains aren't really gains at all. All you're doing is simply tracking the monetary inflation rate if you're lucky.
According to Michael Saylor, we are currently in a different country where foreign currencies are losing value against the local currency. Dollar. In the past 20 years, the Argentine peso has fluctuated against the dollar from 1 to 500. The value of the pesos dropped by 99.8% against the dollar during the period when the dollar depreciated by 75% compared to the S&P index. Michael Saylor. Allow yourself to calculate if you operate a business in Argentina and are prepared to put in the effort. You need to increase your revenues from 1 million pesos to 500 million pesos. It takes more than 20 years to remain stagnant, which is why he believed that no quantity of diligence will help resolve the challenge of being on the losing end of an economic conflict. If you learned something from this video, then please like this video and subscribe our channel Everyday Finance, and we will meet in next video. Thanks.